Hey everyone, and welcome to this month's Redwood Money client update. I hope that you and your family had an awesome month of March. I know for Jordan and I, things started to feel normal again. We're enjoying springtime, mask restrictions have left from Santa Clara County, and making some special memories. We recently celebrated St. Patrick's Day, and that's been a Clark family tradition for a long time where we eat corned beef and cabbage, and we sing Irish songs, and we drink green lemonade. And this year we got to include Sophia in that tradition. So we dressed her up in this adorable outfit. And the behind the scenes of this is we thought that she would wear it all night long, and she promptly pooped through the outfit. So she wore it for probably 30 minutes before we changed her into something else. But I was reflecting back on 2 Marches ago around St. Patrick's Day when all of us were going into lockdown. And last March, when I wasn't able to gather with family, and it was a hard time, I think for us, there was a lot of COVID fatigue. And so now, this March, to be in this situation, it was just special. And I hope that you are enjoying your spring, you're enjoying the month. And in today's client update, I want to just share a couple of things. The first is a quick Redwood Money client update of what's going on in the firm. And then we're going to continue on last month's theme of investing and market volatility. We're now about a month into the war between Russia and Ukraine. Markets have largely stabilized, but I'm going to reflect back on the pandemic investing experience as a way to learn from what to do and how to financially plan proactively during these times of market volatility and uncertainty. So let's jump in first with some Redwood Money client updates. The first thing is that Redwood Money is at 20 clients and growing. So I so appreciate all of your trust. I'm growing much faster than I expected to, but I'm really grateful for this opportunity. And for those of you who have started planning with me, you know that there's a lot of information gathering up front. And so imagine your situation of putting together all of your financial accounts and uploading documents and multiply that by 20. That's basically what my life looks like right now. And I wouldn't have it any other way. I am really enjoying getting to help clarify clients' goals, get people financially organized, and then chart a path towards those goals with the resources you have. So I really appreciate you referring people and trusting me during this time. I also want to remind you, you can see here on the screen these QR codes to log into your financial plan at Right Capital, and if I'm managing assets for you at Betterment, to do the investment login. Just take your smartphone, scan those photos, and you'll be able to log in. You can also access those logins at a very lightweight website that I have live now at redwoodmoney.com, where you can do your client login to your financial plan, to Betterment for investment management, and then also schedule meetings with me. My final point on Redwood Money would just be, I would love to hear from you what you'd like to learn about in future client updates or one-off videos. I call the firm Redwood Money because there's so much more to a financial plan than just investing. So yes, this month we'll be talking about markets and investing again, but next month we could talk about cryptocurrency or real estate or insurance or budgeting. What's something that is top of mind for you? Maybe it's taxes as we head into April, that you would like to learn more about that I can update all of our clients on. If you respond to the email that you got this video in, or you put a comment below, I would love to hear what you'd like to hear more about in future updates. But this month, our topic for financial planning is going to be to continue talking about markets. And now, 2 years into the pandemic, I want to share a little bit of a stock market story with you, because everything's so fresh right now with the news that we've gotten about inflation, about the war in Ukraine. It's hard to know how that's going to pan out. But I think it can be helpful to look back at market cycles that are a little bit more mature, even from 2020 to now, to kind of think about how you reacted in that time period, if at all, and to learn from that in order to inform future decisions and volatility. So I want you to transport yourself back to March of 2020. And this is probably about the time when you found out you wouldn't be going back into the office. It's the time when all of a sudden people who wore masks into a grocery store weren't crazy. They were actually the smart people who were protecting themselves. And we were beginning to understand that this pandemic was going to expand beyond China and into really the rest of the world. And there were so many things to pay attention to at the time. How do you keep your family safe? How do you get a work from home setup? How do you keep business running and family running and maybe educating kids at home? But in the midst of all of this, there was a lot of market volatility. And so you may have seen a headline like this one from CNBC. This was from March 23rd of 2020. And it said, this was the fastest 30% sell-off ever, exceeding the pace of declines during the Great Depression. So this article talked about how the S&P 500, the 500 largest US stocks, which is a commonly measured index or benchmark to look at what the US stock market is doing, took only 22 trading days to fall 30% from February 19th to these lows. And it was the fastest drop of this type since 1934, 1931, and 1929. So we hadn't experienced a drop like this in over 90 years. And investors are dumping stocks. There's a lot of uncertainty, fears about a recession, which did happen. And you got quotes like this one you can see in the article. Don't believe any stock market stabilization is a sign of an investable bottom in US stocks. The next flush down or downturn could, in other words, be days rather than weeks away. So he was basically saying things are already bad and you're probably stressed out about your money, and you should be, because they're probably going to get worse. And I sat there and I looked at my own portfolio and my 401ks and my investment accounts. And, Jordan doesn't actually look at that stuff, which is probably for the best for her. But I was feeling really stressed out, and like a decade plus of saving really aggressively, we were looking at it, and the balances had now fallen by 30% in about a month. And I was thinking, what do I do in this situation? Do I sell? Do I hold? Do I buy more? And it reminded me of 2008 and 2009, which was the first time as an investor that I had the experience of really getting blindsided by the markets really being in turmoil and turning down. And at that point, I made a huge mistake, which was that at the lows or around the lows, I had lost money and I sold. And I thought, investing's too scary. I don't know what's going to happen. It looks like we're in a recession. Housing prices are cratering. And so I sold and I stayed out of the market for really the next 4 or 5 years. Part of that was that I was in college at the time and I was building up debt, but I was also terrified of stocks. Now, that was the worst mistake that I could have made. First, selling, and then second, not buying back in, because those were incredible years to take advantage of stock prices that in hindsight were on sale. So what I did in 2020 was I put on my certified financial planner hat and I wrote an article on Reddit like a good millennial called 5 Investment Steps I'm Taking in a Bear Market, and 4 more I would take if I could. And I thought it was important to talk about this because this was the first bear market or 20% plus decline in stocks since 2009. It had been over a decade. And I wanted to share my thoughts to have people poke holes in it. And a lot of people read this. I had over 1.1 thousand people upvote the article. I had 350 comments. So there was a lot of different things. And these were the things I said I was continuing to do. I was actually increasing my 401k contributions. So instead of selling this time, I was buying more at these lows. And Jordan and I kind of tightened up our budget in some ways to be able to invest more and try to max out those contributions. The second thing was I was continuing my scheduled investments, putting money into the market each month, because if I was happy doing it the month before when stocks were 30% higher, then I probably should feel even happier, even though it was uncomfortable investing at these lower prices. The third thing was rebalancing accounts. And this is simply if in your investments you have a mix of stocks and bonds, and the stocks are for growth and the bonds are for stability, you might have a ratio of like 80% stocks and 20% bonds. And if you deviate a long ways from that, it's going to change the way the portfolio performs. But when stocks drop like this, an account like that might go from 80% stocks to 70% stocks, and then the bond position grows from 20% to 30%. Rebalancing is simply selling some of those bonds which had risen in value to buy more stocks at the lows. And it's a disciplined way to stay invested the way you want to. So rebalancing my accounts instead of letting them drift was the third step. The fourth one was trying not to watch the markets. And that's really hard for me to do. One, it's my bent. It's something that I now feel a responsibility to do as your financial advisor. But also, it's easy to just glue your eyes to it and try to see what's going to happen. And you get in the habit of watching the markets when it's going up. And then that's a tough habit to still be in when they're going down. So instead of just trying not to watch the markets, what I did was I decided I was going to read books about investing like a nerd and also look at my financial plan. And that helped me to see that things were still on track in spite of the recent volatility. And that's what I'd encourage you to do during times of volatility. Maybe not read the books, but look at your financial plan. Call your financial advisor. Let's talk about these things because these are the moments where it's important to focus on the things we can control. And one of those things we can control is the fifth item I did, which is keeping my short-term money conservatively invested. So money in my emergency fund and in a fund that I had for putting on a down payment on a house, that was already in 100% bonds. It wasn't exposed to stock market risk at all, and I kept it that way. And that's why when I'm talking to you as clients, we'll have different buckets of money. And even if your 401k or retirement accounts are invested very aggressively, maybe 90% plus in stocks, we might have a chunk of money for your emergency fund or near-term expenses in the next 6, 12, or 18 months that's very conservatively invested because we don't want to expose it to stock market risk. Now, I shared a few other things that I would have done if I could. And those things were invest a lump sum of cash if I had it. So if I had a lump sum of cash at that point, and I still recommend this to clients when the market declines, that might be a good time to put that to work in the market. Another one would be Roth conversions or potentially switching investment advisors. If you used to have really high taxable gains in an account that an investment advisor was managing for you, for instance, in a high fee product like an annuity or in a high fee mutual fund, those might be good times to switch advisors and switch products or at least do some tax loss harvesting. So these were my ideas, and it was the exact opposite of what I had done previously, and I wrote this article on March 20th, so right before the bottom of those declines, and I got some super interesting feedback from people. This is what one person said. He quoted increasing 401k contributions, and he said, if you want to throw your money away, I'll take it, with no fees either. Somebody else who was really concerned for people and posted an article saying that we might even be social distancing for up to 18 months said, this is real. This is a plague, dude. There are going to be tens of millions of newly unemployed and hungry Americans very shortly. People that are going to need cash should not be upping their blanking 401k contributions. So not only saying what I was doing was a bad idea, but that other people definitely shouldn't be doing it. Somebody else raised an interesting question. It could take years for the market to return to where it was a month ago. Do you really think we're at a bottom now? I don't. And then this last one, which kind of broke my heart. It was somebody who, of course, you can do whatever you want with your money, but he said, I did the exact opposite. I sold after the first drop and converted everything to cash. I lost about 20% of my portfolio doing this, but I don't see this market growing from here. At that point, the Dow was at 20,000. If anything, I expect it to drop to 15 to 16,000 over the next few months as we start to see the real effects of the coronavirus. I'll wait for things to level out at a new bottom and then rebuy my portfolio again. Now, for those of you who know what the market did next, this is a really sad thing to read because even though this guy probably felt really smart at the time for selling before things hit their lows, after that, by March 23rd, which was 3 days after he wrote this post, stocks wouldn't go lower again. And I don't know if they will ever hit these lows again. So he thought that the Dow was going to go lower from 20,000. Well, as of today, March 29th, 2022, the Dow was at 35,000. Not only did it never hit 15 or 16,000, I don't think it ever will again. And what's unfortunate is coronavirus did get worse. And so if he was waiting for COVID news to improve to invest, he never would have gotten back into the market and would still be waiting when stocks have doubled from there for his opportunity. And this is why I think staying the course is so important, why having a plan that includes volatility is so important, and why we look at this in your financial plan. Is I want to make sure you feel comfortable with your investment strategy and that we can talk about these things because all of these voices are not ones that I say, oh my gosh, they're being ridiculous. I think that's the voice that we all have in the back of our head, that we're investing sometimes when we're feeling scared because that can be the way to get the best returns, but it's also a scarier time. And that's why stocks drop. They don't drop because things are going great. They drop because things are uncertain, because we're wondering what's going to happen in the economy. So what can you do with this information? Well, first, let's talk about what came next. In that point where I was writing that article and everybody was wondering what to do and everyone was paying attention to the news cycle, well, the government quickly stepped in and provided trillions of dollars of stimulus. And news kept coming in. We found out that COVID, while it was still very deadly, that there were certain groups that were at greater risk. And our society as a whole, in 2 years, in this crazy experiment that I'm sure we're all healing from, we adapted relatively quickly. And so by June 7th, only a few months later, there was headlines like this, same author in CNBC saying S&P 500 erases its losses for the year as stocks rally on reopening optimism. And this to me is the greatest testament for why trying to just sell and then buy later when things settle down is a terrible idea. Is you don't know when things are going to improve, and they can improve quickly. We've seen it with Russia and Ukraine, where stocks have really fully gained the losses that happened over the last month. And this consistently happens in markets, and it's something that we need to pay attention to. But then things didn't just recover from the losses. In the midst of the stimulus, a lot of technology stocks did really well and other markets adapted. And you can see that the S&P 500, the same thing that was down 30% in the greatest decline since the Great Depression, had doubled from its pandemic bottom, marking the fastest bull market rally since World War II. This is why we stay invested, is you don't know when you're going to have years of expansion or declines, but if you're invested in all of them, you're able to have exposure to those expansions. It took 354 trading days between March 23rd, which was the COVID trough when that first article was written that we read, to double, and that happened August 16th of 2021. Now, personally, what happened with the investments that we made during that time? Well, I'm sitting here talking to you as a financial advisor, and even though it was terrifying to be investing at that point, I attribute some of the work flexibility that I got, the ability to start this company, to the ability to stay the course that I had back then. Because in starting this company, I needed to have reserves, and part of those reserves came from investments that grew during the pandemic as I stayed disciplined and stayed invested. And I see it as my job as your advisor to help you to have the best chance of having good outcomes as an investor by staying disciplined and staying the course. So what are some principles that we can have as we look back at the last 2 years and we look forward at the next 20 or 30 years of investing together? Some of the principles and takeaways that are timeless from this is the first one is that the stock market is forward looking. So notice here the blue line is what stocks did and the yellow line is coronavirus cases. I think it's amazing to see that stocks had almost dropped to their lows before coronavirus cases even started ticking up. What was happening was the US was looking at cases in other places and saying COVID is coming, and that means lockdowns are coming. That's going to hurt our economy, and that means stock prices, because they're based on future profits, are going to go down. So if you waited until COVID cases hit your peak and you thought that's going to be the best time to invest, it actually wasn't. Stocks had recovered by then. Stocks are forward looking, and so this is what makes timing the market so difficult, is that before the case counts increase, the stocks decrease. Before the recession hits, stocks decline, and by the time you're in an economic recession, they've probably recovered because we're looking towards the recovery. And for those of you who are saying, Russia just invaded Ukraine, now's the time to pull out of the stock market. Well, stocks had already declined at that point. They were at their lows. And by the time we were 2 weeks into the war, stocks had mostly recovered. So you have a couple of options here. You can try to predict the future and be forward looking and digest all of the information, which is exceedingly difficult to do. Or you can accept that we can't predict the future and stay invested for the long term and have the right buckets of money, conservative money for short-term goals and more aggressive money for long-term goals, and forget trying to predict the future at all. The next thing is that smart investing can feel scary in the moment. Even as I was writing that article about what I was doing and portraying confidence, I felt yucky seeing my account balances going down. And so I see my job as your advisor as helping you to stay invested and to look back at historical incidences of what's happened during these declines to help you see that when stocks are declining, it feels like it's never going to end. And when stocks are increasing, it feels like it's never going to end. And so I want to make sure we don't get too high and too excited or too complacent during a bull market or too depressed during a bear market, because both are part of the investment experience. And we want to make logical, not emotional decisions based on your situation and not based on just what other people are doing. The third thing is that proactive financial planning moves can be done in any market. And so what we're going to do is not focus on what the market's doing, but based on what we're seeing in your accounts and your unique advantages, whether that's having access to a special 401k or a health savings account or a Roth IRA or having a company stock plan or some losses in an account. We'll look at all of these things and say, what's the smart choice in this environment to try to maximize your net worth or increase your likelihood of achieving your goals? Whether the market's going up or down or sideways, there are always financial planning moves we can make. And I think one of the things that's nice about that is I'd rather rebalance accounts than, when you want to take action because stocks are falling, than do something like sell out of everything. It gives us something to focus on that's beneficial rather than trying to predict the future, which is difficult. And that brings us to the last point, which is just that you can make good choices with incomplete information. I think it's so interesting that one of those posts talked about 18 months of social distancing. And this was the guy who was saying, don't increase your 401k contributions because COVID cases are going to increase. And you know what? He was right. He was right that COVID cases would increase. He was right that things were going to get much worse, that unemployment would rise, but he was totally wrong about what the stock market would do because there are constant inputs coming into the market. And what he was wrong about was the fact that the government would provide incredible stimulus to try to keep us afloat during a difficult time economically, and that stocks would actually do really, really well. And so this is a good thing for you to recognize because we don't need to see the future in order to make smart decisions. We can make good choices with incomplete information. And if, based on the information we have, it's a good choice, even if the investment doesn't pan out perfectly, what we can do is we can analyze what was the information we had and do we need to change something about our decision making. Sometimes you just, you swing and you miss, and that's okay. But what you want to do is make sure that based on what we know about the past, we're making decisions that are things that are rational, rather than trying to predict the future and make decisions based off of that. All right, one final thought for you as I close this commentary on markets. And this really, to go from the really complex to the really simple, I just want to share this quote from John Bogle. He says, investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes. What we're going to do at the beginning of your financial plan is make sure that you're doing those few things right. We're going to make sure that you're in low-fee investment products, that you're situated well based on your age and your risk tolerance in the right mix of stocks and bonds and real estate and other asset classes, that you're making tax-efficient investment decisions, all things that will maximize that long-term growth. That happens right at the beginning. But then we're going to spend your entire investment career avoiding serious mistakes. Serious mistakes like investing in one really risky stock or being over-concentrated in one place. Serious mistakes like trying to time the market and sell out when things are low and then regret when you're not buying at highs. Serious mistakes like missing a tax planning opportunity or not having an account that you thought was invested. I think of the redwood trees, and I think of a specific trunk in Big Basin Redwood State Park in Santa Cruz Mountains. And there's this redwood, and it was like 2,000 years old before it died. And so there's 2,000 tree rings that you can see from all the years of growth. And they combine into this massive trunk. This was a huge tree that was majestic to behold. It's what I want my client's financial situation or their legacy to look like, something that's beautiful and enduring. What's cool is when you look at each year, you'll see some years the tree ring's really wide because it was a great year for growth. In the early years of the tree, during years where the rain was falling and everything was good, and then other years, you can barely differentiate between the tree rings because they're so tight together. It's years of drought. It's years of wildfire. It's difficult times that the tree had. But those are just blips in a narrative or a story of much greater growth. So what we want to do is avoid those serious mistakes that would halt the growth altogether and stay invested, whether it's a boom year where we've got those broad tree rings and stocks are growing by 20%, or it's a tough year where they decline by a few percent. Being smart, staying the course, and staying in a position where you are positioned for growth. Because ultimately, with a redwood tree or any other tree, if you want it to grow, it's not about jumping around to different climates. It's about rooting yourself in a position where you can experience maximum growth. And I see my job as the advisor as us planting those seeds, positioning you for growth, and making sure that during the good years and the bad years, we're making those successful investments. We're doing a few things right and avoiding serious mistakes. So thanks for listening. I hope that you'll share this with friends or with family if you think they could use this encouragement at this stage. And if there are things you want me to share about next week or follow-up questions, just respond in the email or give me a comment below. I would love to hear from you.